How central banks control your future without you noticing. Central banks operate quietly in the background of the economy, yet their decisions ripple through every aspect of our financial lives. From the interest rate on your savings account to the cost of borrowing for a new home, the choices made in a central bank's boardroom shape your future in ways you might never even realize. While governments pass laws and politicians make headlines, central banks wield a subtler, but no less powerful, influence. They determine the cost of money, control the supply of cash, and adjust financial levers that affect inflation, employment, and overall economic growth. Because these mechanisms operate largely behind the scenes, the average person rarely notices their impact until it hits their paycheck, mortgage, or grocery bill. In essence, central banks control the rhythm of the economy, guiding markets and shaping financial behavior without ever needing a voter's approval. Understanding how central banks work is essential for anyone who wants to see the hidden forces steering their financial future. By examining the tools they use, interest rates, money supply control, quantitative easing, inflation targeting, and unemployment management, we can uncover how these institutions influence everything from your daily expenses to long-term investments, all without most people even realizing it. Setting interest rates. One of the most visible tools central banks have is the power to set benchmark interest rates. These rates influence the cost of borrowing and the return on savings across the economy. When a central bank raises interest rates, loans for homes, cars, and businesses become more expensive, which slows spending and borrowing. Conversely, lowering rates makes borrowing cheaper, encouraging economic activity and investment. The effects of interest rate decisions ripple far beyond individual loans. Higher rates can strengthen a nation's currency by attracting foreign investment, while lower rates can stimulate growth during economic slowdowns. Importantly, central banks set these rates in ways that aim to balance inflation, employment, and economic stability, but the average person feels the impact indirectly through mortgages, credit cards, and personal loans. In essence, by adjusting a few percentages, central banks can quietly shape the pace of the economy and, by extension, your financial future. Interest rate decisions also influence asset prices. Low interest rates make bonds less attractive and can drive investors towards stocks and real estate, inflating asset values. High rates can cool overheated markets, slowing borrowing and investment. This subtle manipulation of incentives allows central banks to steer both consumer behavior and investor sentiment without requiring direct intervention in individual financial choices. Controlling money supply. Another critical lever is the control of money supply, the total amount of money circulating in the economy. Central banks can increase or decrease the supply of cash and credit, which directly affects inflation and purchasing power. When more money is injected into the system, each unit of currency loses value slightly, pushing prices upward. Conversely, reducing the money supply can help cool inflation and stabilize currency value. This control operates largely unseen. Most people don't realize that the amount of money available for lending, spending, and investing is orchestrated from the central bank. Yet every paycheck, grocery bill, or rent payment is influenced by these decisions. By expanding or contracting the money supply, central banks indirectly determine how far your dollar goes and how accessible credit is. It's a form of economic steering that occurs in the background, subtly shaping the financial landscape of everyday life. Controlling the money supply also allows central banks to respond to crises. During recessions, increasing liquidity can stimulate spending and investment, while during overheating periods, contraction can help prevent runaway inflation. This delicate balancing act requires foresight and coordination, but its effects permeate through the economy, influencing everything from job growth to mortgage rates. Quantitative easing, buying assets to inject cash. Quantitative easing, or QE, is one of the more modern tools central banks use to influence the economy. It involves purchasing government bonds or other financial assets to inject cash directly into the banking system. The goal is to lower interest rates, increase liquidity, and stimulate borrowing and investment. Unlike traditional monetary policy, QE bypasses the direct setting of interest rates and works by expanding the monetary base itself. The effects of QE are often subtle but significant. By increasing demand for bonds and other assets, central banks push down yields and encourage investors to seek higher returns in stocks, real estate, or corporate debt. This can boost asset prices and create a wealth effect, where rising asset values encourage spending and investment. Ordinary citizens might not notice these moves immediately, but the consequences, higher home prices, stock market gains, or changes in borrowing costs are felt in everyday life. Critically, K also works as a signal of economic intent. By committing to asset purchases, central banks communicate confidence in growth and stability, influencing expectations among investors, businesses, and consumers. It's a subtle form of control, shaping both perception and reality, all without direct intervention in daily transactions. Inflation targeting. Inflation targeting is the practice of setting explicit goals for price stability, usually expressed as an annual inflation rate. Central banks announce targets such as 2% and then adjust monetary policy to achieve them. This approach provides predictability to markets and businesses, influencing decisions on wages, pricing, and investment. For the average person, inflation targeting is invisible but pervasive. It shapes the pace at which salaries increase, the cost of groceries, and the pricing of loans. By managing inflation expectations, central banks stabilize the economy while indirectly guiding spending and saving behavior. Predictable inflation reduces uncertainty, allowing households and companies to plan for the future with greater confidence. Furthermore, inflation targeting gives central banks credibility. When people trust that price increases will remain moderate, economic activity is more stable. Businesses can make long-term investments, and lenders can issue loans with predictable returns, all while the central bank quietly guides the economy toward desired levels of price stability. Managing unemployment expectations. Central banks also influence the labor market, often indirectly, by managing expectations around employment. Policies designed to control inflation, interest rates, and money supply inevitably affect hiring decisions. For example, lower interest rates can encourage business expansion, leading to job creation, while higher rates may slow hiring to prevent the economy from overheating. This influence is subtle but powerful. By shaping expectations around economic growth and stability, central banks can nudge labor markets without directly intervening in hiring practices. Workers may experience changes in wage growth, job opportunities, and career mobility as a result, often without realizing the connection to central bank policy. Moreover, some central banks explicitly balance their dual mandate of controlling inflation while supporting maximum employment. This means they constantly weigh policies that stabilize prices against those that encourage job growth. The result is a careful orchestration of economic conditions where the central bank's invisible hand guides both macroeconomic outcomes and individual financial realities. Regulating bank lending. Central banks have a critical role in regulating how commercial banks lend money, a function that profoundly shapes economic activity. By setting reserve requirements, how much capital banks must hold in reserve relative to deposits, central banks control the amount of money banks can create through loans. If reserve requirements are high, banks have less capacity to lend, tightening credit conditions and slowing economic growth. Conversely, lower reserves allow banks to expand lending, stimulating spending, investment, and employment. This regulation might seem technical, but its effects touch everything from mortgage rates to business financing. Through regulatory oversight, central banks also monitor the health and risk exposure of financial institutions. They ensure banks maintain adequate capital, adhere to lending standards, and avoid excessive speculative behavior. By doing so, central banks protect the economy from financial instability that could arise from reckless lending practices. While this oversight is largely invisible to the public, it prevents systemic crises that could devastate markets and individual finances. Interest rates and lending standards are deeply interconnected. When central banks adjust benchmark interest rates, commercial banks adjust their lending practices accordingly. For example, higher interest rates may reduce borrowing for discretionary spending, while lower rates encourage expansion and investment. The result is a subtle steering of economic behavior. Households may delay taking on loans, and businesses may postpone capital expenditures, all in response to signals from the central bank. Finally, the regulation of bank lending reinforces confidence in the financial system. Knowing that central banks oversee the safety and soundness of banks encourages public trust, making people more willing to deposit money, take loans, and invest. This trust underpins the smooth functioning of modern economies and exemplifies how central banks shape financial conditions quietly but profoundly. Acting as lender of last resort. One of the most important roles central banks play is acting as the lender of last resort, a function that stabilizes the financial system during crises. When commercial banks face sudden liquidity shortages, unable to meet withdrawal demands or fund operations, the central bank can step in to provide emergency funding. This prevents panic-driven bank runs and preserves confidence in the banking system, which, if lost, could cascade into a broader economic collapse. The lender of last resort function is vital because financial markets are interconnected and fragile. Even a single bank failure can trigger contagion, spreading instability across sectors. By providing emergency loans, central banks prevent small shocks from becoming systemic disasters. While the public rarely sees this process, it is essential in maintaining economic continuity, protecting jobs, and preserving household wealth. This role also allows central banks to act quickly during periods of market stress. During a sudden financial crisis, such as a sharp drop in stock prices or a liquidity freeze, immediate intervention can restore stability. Banks gain confidence knowing the central bank can step in, which reduces panic withdrawals and stabilizes credit markets. Without this safety net, economic disruptions would be far more severe and widespread. This expectation can stabilize markets even before any intervention occurs, preventing irrational behavior and fostering a calmer economic environment. Finally, this function underscores the central bank's ultimate power. It can create money or credit when needed to stabilize the financial system. While ordinary people experience the outcomes indirectly through stabilized prices, continued lending, or employment security, the underlying mechanism is a testament to the central bank's quiet but essential influence on everyday financial life. Influencing currency value. Central banks wield significant influence over the value of their nation's currency, a factor that impacts trade, investment, and domestic prices. By adjusting interest rates, controlling money supply, or engaging in foreign exchange operations, central banks can affect the exchange rate relative to other currencies. A stronger currency reduces import costs, but can make exports less competitive, while a weaker currency has the opposite effect. These adjustments ripple across the economy, influencing everything from consumer prices to corporate profits. Currency value influences inflation and purchasing power directly. If the currency weakens, imported goods become more expensive, driving inflation higher. Conversely, a stronger currency can contain inflation but may hurt domestic manufacturers competing internationally. Central banks carefully balance these dynamics to achieve stable economic growth, all while maintaining confidence in the currency. Central banks also intervene directly in forex markets when needed, buying or selling foreign currencies to stabilize exchange rates. These operations are largely invisible to the general public, yet they shape global trade and capital flows. Exporters, importers, and multinational corporations adjust their strategies based on these fluctuations, illustrating how central bank actions reverberate across economies. Finally, currency influence illustrates the central bank's power to shape long-term economic behavior. Citizens may not notice daily interventions, but the overall trajectory of the economy, from inflation to trade balances, is guided by these behind-the-scenes manipulations of currency value. Controlling credit availability. Central banks control the availability of credit across the economy, a factor that directly influences spending, investment, and economic growth. By adjusting interest rates, reserve requirements, and lending regulations, central banks can either tighten or loosen the flow of credit. Easy access to credit encourages businesses to expand and consumers to spend, while restricted credit cools overheated markets and prevents unsustainable debt accumulation. Credit availability also impacts consumer confidence. When loans are accessible and affordable, households are more likely to buy homes, cars, and other big-ticket items. Conversely, restricted credit can slow economic activity, reducing spending and potentially leading to slower growth or higher unemployment. Central banks manage this delicate balance carefully to maintain overall stability. Business investment is particularly sensitive to credit conditions. Companies rely on loans to fund capital expenditures, research, and expansion. By controlling credit, central banks can indirectly steer business decisions, affecting long-term productivity and employment. Industries that are capital-intensive, like manufacturing or infrastructure, are especially influenced by these policies. Finally, by controlling credit, central banks manage risk across the economy. Well-calibrated policies prevent excessive borrowing, maintain banking stability, and protect consumers from over-leveraging. This invisible influence demonstrates how central banks guide both macroeconomic and individual financial outcomes through subtle yet powerful mechanisms. Signaling market confidence. Perhaps one of the most understated powers of central banks is their ability to influence market confidence simply through communication. Statements, forecasts, and policy announcements shape investor, consumer, and business expectations, which in turn guide economic behavior. A reassuring central bank statement can calm markets, stabilize currencies, and encourage investment even before any policy action is taken. Market confidence is critical because economic activity is as much psychological as it is financial. Businesses make hiring and investment decisions based on expectations, and consumers make spending choices based on perceived stability. Central bank communication thus serves as a tool to shape behavior indirectly, guiding decisions across the economy without direct intervention. Signaling is also a preemptive tool. By indicating future policy changes, such as expected interest rate hikes or quantitative easing, central banks prepare markets for shifts, reducing uncertainty and volatility. Investors, lenders, and borrowers adjust their strategies accordingly, smoothing economic transitions that might otherwise be abrupt or disruptive. This influence extends globally as well. Central bank statements affect foreign investors, currency traders, and multinational corporations. A single announcement can alter global capital flows, exchange rates, and commodity prices, demonstrating the broad reach of these signals. Even when no immediate action occurs, perception alone shapes economic outcomes. Finally, signaling reinforces credibility and trust. A central bank that communicates clearly and consistently earns confidence, which allows for more effective policy implementation. When people trust that the central bank will act responsibly, markets stabilize, lending continues, and the economy functions more efficiently, all while individuals remain largely unaware of the subtle steering at work. Buying government debt. Central banks frequently buy government debt as a way to influence economic conditions, a practice commonly referred to as open market operations. By purchasing government bonds, the central bank injects liquidity into the financial system, increasing the supply of money available for lending and spending. This is especially important during periods of economic slowdown, as it encourages borrowing, investment, and consumption to stimulate growth. When central banks buy government debt, they also lower the yields on those bonds. Lower yields reduce borrowing costs for both the government and the private sector. For governments, this means debt servicing becomes cheaper, freeing resources for social programs, infrastructure, or other public spending initiatives. For private borrowers, lower yields translate into cheaper loans and mortgages, which can spur both individual and business investment. The action also sends a signal to the markets. By buying debt, the central bank signals its commitment to supporting the economy, reassuring investors, and reducing market uncertainty. This psychological impact is as important as the financial effect, as expectations about future economic stability influence investment decisions, employment, and consumer confidence. Buying government debt also interacts with inflation and interest rates. Finally, government debt purchases can influence the broader financial markets. By lowering yields on safe assets like bonds, central banks encourage investors to seek higher returns in stocks, corporate bonds, and other riskier assets. This can create wealth effects, raising asset values and stimulating spending, all while the mechanics of debt purchases remain largely invisible to the average person. Encouraging or discouraging investment. Central banks guide economic behavior by influencing where and when businesses and individuals invest. By adjusting interest rates, controlling credit availability, or signaling future monetary policy, central banks can either encourage investment in growth initiatives or discourage speculative or high-risk projects. Low interest rates, for example, make capital more accessible, incentivizing companies to expand operations, hire more workers, or invest in research and development. Conversely, higher interest rates can discourage borrowing and temper investment, preventing the economy from overheating. Businesses respond to these signals by delaying or scaling back projects, while consumers may postpone major purchases. In this way, central banks steer both corporate and individual financial decisions indirectly, guiding the economy toward desired levels of growth and stability. Central bank actions also shape investor confidence. This demonstrates how central banks influence not only the availability of funds, but also the psychological conditions that affect economic behavior. Finally, by encouraging productive investment and discouraging speculative risk-taking, central banks indirectly shape economic stability. Well-calibrated investment incentives promote sustainable growth, reduce the likelihood of asset bubbles, and ensure that resources are allocated efficiently across sectors, all while individuals remain mostly unaware of the guiding force behind their financial decisions. Impacting mortgage and loan costs. Central banks have a direct impact on the cost of borrowing for households and businesses by influencing mortgage and loan rates. Benchmark interest rates, set by the central bank, determine the baseline cost of credit throughout the economy. When rates are low, mortgages, personal loans, and business credit become cheaper, stimulating spending, home buying, and corporate expansion. High rates have the opposite effect, cooling demand and controlling inflation. Changes in mortgage and loan costs ripple through the economy in multiple ways. Lower borrowing costs can increase demand for housing, raising property values, and creating wealth effects that encourage spending in other areas. Conversely, higher borrowing costs can slow the housing market, reduce disposable income, and restrain consumer spending. Central banks thus influence not only financial markets, but also everyday lifestyle choices, including home ownership and family planning. Finally, mortgage and loan impacts are interconnected with inflation, currency value, and market expectations. By managing borrowing costs strategically, central banks stabilize both consumer confidence and financial markets, demonstrating their behind-the-scenes control over daily financial decisions, shaping long-term economic behavior. Central banks shape long-term economic behavior by guiding expectations, influencing credit allocation, and setting the overall tone for financial decision-making. Policies implemented today, interest rates, quantitative easing, or inflation targets affect business investment decisions, household spending, and saving behavior for years to come. These actions subtly mold the economy's trajectory over time. For example, consistent low-interest policies may encourage risk-taking, entrepreneurship, and innovation, while prolonged high rates might promote savings and reduce debt accumulation. Households adjust their long-term plans based on the affordability of credit, and businesses adjust capital allocation according to borrowing costs and expected returns. These cumulative decisions ultimately define growth patterns and economic resilience. Over time, this shapes norms around debt, investment, and consumption, embedding monetary policy into the broader fabric of the economy. Finally, shaping long-term economic behavior allows central banks to pursue macroeconomic stability. By influencing the aggregate behavior of consumers, businesses, and investors, they reduce the likelihood of economic bubbles, excessive debt accumulation, and market volatility. While these effects are often invisible in daily life, they profoundly influence the economy's long-term health. Using forward guidance to steer expectations. Forward guidance is the practice of communicating expected future policy moves to shape economic expectations today. Central banks use forward guidance to provide clarity about the likely path of interest rates, inflation targets, and other key economic variables. This communication tool allows markets, businesses, and households to plan accordingly, stabilizing behavior even before any actual policy change occurs. By signaling intended future policies, central banks can reduce uncertainty and volatility. Investors may adjust portfolios, businesses may time capital projects, and consumers may plan major purchases based on anticipated borrowing costs. This preemptive influence ensures that markets respond gradually rather than through sudden shocks, enhancing economic stability. Forward guidance also affects inflation expectations. If the public believes the central bank is committed to maintaining price stability, wage negotiations, borrowing, and investment decisions will reflect that confidence. Conversely, ambiguous communication can increase uncertainty, potentially destabilizing financial markets and consumer behavior. Finally, forward guidance strengthens credibility and trust. Clear, consistent messaging ensures that both domestic and international actors can anticipate policy impacts, fostering confidence in financial systems. Through this subtle yet powerful mechanism, central banks shape expectations, behavior, and economic outcomes without direct intervention in daily financial decisions. Central banks may operate behind the scenes, but their influence touches nearly every aspect of your financial life, from the cost of borrowing and saving to employment opportunities and the stability of prices. They control interest rates, manage money supply, deploy quantitative easing, target inflation, and shape unemployment expectations, all without you noticing day to day. If you found this breakdown eye-opening, make sure to like this video, subscribe to our channel, and leave a comment below sharing which central bank tool surprised you the most. Your engagement helps us create more content that reveals the hidden forces shaping your financial future.